About 1 minute, folks, and we'll try to remember some housekeeping at the end. This is the last in our series of our webinars till fall. So if any of you have any ideas what you'd like to see presented, please email us, and Matt and I would be more than happy to look into that. Thanks for all that have been joining. And Matt, you might remind people that it will be posted on the website for anybody who wants to.
Absolutely.
Okay. Okay, we have 6:02 Eastern Daylight Time. We're still coming on here. So the farmers like myself are in for the night. I got rained out from planting a few soybeans, so maybe we'll have some rural attendance tonight.
Sure looks like the heavy rain missed us, though.
Yeah, I didn't get that much. I'm hoping in the morning to go back if it's not raining in the morning, and I think the rain may have gone to the north. So, okay, Matt, whenever you think.
All right. Well, yeah, I think we can get going. 6:02. So we'll get it started. Thank you everybody for joining us today. This, as Daryl mentioned, this is our last webinar for this session. We'll start them back up in the fall. We thank you for your support, and also thank you for watching the recordings that we've been posting to our website and also on our Facebook page. This one will also be recorded and posted, and we thank our friends at Canoe for allowing that and for joining us again. We're happy to have Bob and Dave from Canoe join us today. If anybody remembers, almost a year ago to the day, Dave and Bob joined us, and Dave gave us a presentation on his energy fund. Daryl and I believed that energy was going to be a spot that would reward our clients, and we're happy to report and thank Dave, as he's up about 83% since that last webinar we had. So great job to Dave and the team at Canoe, and we continue to trust you guys with our clients' portfolios. So I'll say that we do have Q&A enabled today. So if you have a question, please put it into the Q&A tab at the top, or the chat button at the top. We will deal or answer all the questions at the end of Dave's presentation. So at this point, I'll let Bob introduce Dave. Bob Mahoney is our local representative with Canoe, and he's been a great help to us in learning about the funds and getting us the information we need. So Bob, I'll let you take it in and introduce Dave.
Great, thank you. Thanks, Matt and Daryl, for inviting us to speak, and on behalf of myself and Dave and everybody at Canoe, we really appreciate the opportunity to speak with the end clients that are on this call, and of course those that will dial in after the fact. So before we start, I just have to go through a disclaimer, especially since Matt mentioned the 1-year number. It's probably even more pertinent, but the content of this presentation is not to be used or construed as investment advice, as an offer to sell, or the solicitation of an offer to buy, or an endorsement, recommendation, or sponsorship of any security or entity. This video includes forward-looking information that is based on forecasts of future events. Canoe Financial may not update the information to reflect changes after this date. These statements are not guarantees of future performance, and risks, events, and other uncertainties may cause actual results to differ from the information presented in this video. These risks include changes to or volatility in the economy, politics, capital and securities markets, interest rates, currency exchange rates, business competition, technology, and law, or when significant events occur. Do not place undue reliance on forward-looking information. In addition, any statement about companies is not an endorsement to buy or sell any security. Commissions, trailing commissions, management fees, and expenses all may be associated with mutual fund investments. Please read the prospectus before investing. Mutual funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Please review the full disclosure that will be presented at the end of this call. So we're done with that. So I just want to take you through a really quick overview of Canoe. Our 3 main tenets are active, independent, and focused. Active means to us actively managed investment solutions. The independence is reflected in the fact that it's a privately held, employee-owned, entirely Canadian company, and focused reflects the very tight lineup of solutions that we offer to the market. We were founded out of Calgary as an open-ended mutual fund company on February 14th, 2011. We now have offices in Toronto and Montreal as well, which allows us to cover the entire country. Next. I just want to really focus on the donut chart. This chart just displays how diversified our lineup is between different asset classes and fund types. You can see the 14% gray, which represents the assets that Dave and his team manage, which would reflect about $3 billion of our $23 billion. We want to thank all of our advisors like Matt and Daryl, and of course you as clients are helping us have this phenomenal growth over the years. Being more Canadian focused, this is our lineup. So Rob Taylor is our CIO. Dave and his team are in Calgary. Rohan is in Toronto leading up our domestic fixed income team. Sajan is also in Toronto running small mid-cap and working with Rob. Fabian is also in Toronto, looks after a global equity portfolio. And Steve Gregorio is out of our Montreal office doing equity income and preferred shares. Where we don't have the expertise or the bandwidth, we have select sub-advisors. We have Pinestone running global U.S. and international. Reams Asset Management is a U.S.-based global fixed income provider, and then Fiero Comox is a private equity offering that we also have at Canoe. Now to the most important part. Obviously, many on the line might have seen Dave roughly a year ago. So David has been with the firm essentially from day one and on these funds since then. His partner, Nicholas Sokol, is a dedicated energy trader, which is one of the differentiating aspects of our team. He has 19 years experience in portfolio management as well as an equity analyst. He was the head of portfolio management at Rain Capital, and also, as I mentioned, has been with Canoe, but also came to us from Peters & Co., which is a Calgary-based energy investment dealer. He is boots on the ground in our founding office in Calgary, is always available to us and very insightful. So given the timeliness of this with what's going on in the Iranian conflict, things we've seen in Venezuela, and also the powering of AI, I think, Dave, we should let you take it away. So thank you for dialing in.
Okay, thanks, Bob, and thanks, guys, for having us. And so, yeah, I'm going to go through some big picture stuff, talk kind of about the here and now, about what's going on that's top of mind for everyone. But yeah, I'm not going to do a complete page flip and talk to everyone exactly on every single slide that we have in our deck. So look, where do I start on this? I would just say it's important for people to understand, like, the title of our last fall presentation was Still on Track. That was September 2025. And so as much as we're all kind of enjoying that energy stocks are doing pretty good, kind of to start 2026, this and that, I would just tell you, we have not felt embracement for the last 2 years. It's been hesitancy, reluctancy, yeah, but Carney, yeah, but pipelines, yeah, but OPEC, yeah, but Trump tariffs. Like, people have been fighting our message, and you guys know that if you dialed into this call last year, we had a pretty constructive message, and I would just say the last couple of years, energy has been doing pretty well, right? If you've been in the right subsectors of energy, which is how we manage these funds, and I think that's really important for you to think about in the here and now, as everyone's getting bulled up on oil. Are you sure your entire energy exposure should be oil stocks? I think we've done a good job of moving capital around in these funds, avoiding some bigger drawdowns, having some of the right names, having some of the right subsectors. But I would say, like, our funds were up 25% in 2024, 25% in 2025. we were doing pretty good, but to call it out, if you just own a broad-based number of energy stocks in that period, you kind of were flattish while other sectors were doing quite well. So other sectors have outperformed and done really well the last couple of years. But then as you enter this year and everyone's bearish oil and energy and they're all worried about a supply glut coming and everyone's been taking energy weight down, we were telling our clients to be trying to look up instead of just looking down with everyone else. And I would just say that's kind of how the year started. And this is not an Iran war scenario. This is kind of what Bob talked about. If we all recall, in January, February, energy stocks were doing quite well in that period before the Iran war. Energy demand tied to AI and software and these other sectors breaking down. Like, the stocks were doing really well before the war. So I think that's really important to understand. And then as the war's been playing out, we've kind of been dumping fuel on the fire, changing the thematic of energy. But I think understanding that this, I get worried as an energy manager when it's been a 3-year ride up and to the right and everything's going up and everyone's high-fiving. And I'm just trying to get you to understand, we have felt our clients be very reluctant and hesitant for the last number of years. There has not been embracement. That's changing, but just that dynamic is really important to understand. I think to simplify this for everyone on this call, there's 3 stages of an energy cycle: disbelief, optimism, and euphoria, okay? When we play out the last 2-3 years, like I said, we've been in that red line, and the energy sector has been kind of going sideways. The Canoe Energy funds have been outperforming given our subsector approach and names, etc. But it's just kind of this kind of Jan, Feb, March into April period that I would just say I think we're at the beginning or in the infancy of the optimism phase. And this is the prize for the cycle. You don't want to miss this optimism phase, okay? This is where you get higher valuations than you think on higher commodity prices than you think. You get the combination of those two things. And so we've been saying the title of our presentation to start the year before any of this happened, we're like, we are getting closer to moving out of this disbelief stage to optimism. Lots of positive things have been happening the last handful of years. Stocks are outperforming the commodities. Everyone's looking down entering the year. So we've kind of been right on that, and we didn't predict the Iran war. But I would just say, and these energy cycles are 12-year cycles. We think we're in year 6. They last 12 to 15 years sometimes. They never go in a straight line. They never go up and to the right. So, but you have to have a view of where we are. And that's where we think we are. And there's more bullish people today than there was, but we still think that there's quite a bit of legs in this optimism phase. But your positioning in the sector needs to change over time, which I'll get into as the presentation goes on. I mean, these are big picture slides that I think we talked to you guys about last time, but I think just keeping them in the back of your head, we're in a commodity cycle. In a commodity cycle, it's not just energy. There's a hard asset cycle. These forces on the left, populism, deglobalization, energy security, and deficits, these are big legs of the stool, if you will, that are themes. They've been around here for now 2-3 years, but they have not been around here for 10-15 years. So if you think about your own portfolios, you need to invest differently today than you have had to the last 10-15 years. If Rob Taylor, our CIO, was on presenting, he's the best portfolio manager I've ever met. We're very aware of, we're in a war cycle, we're in an age of populism and all these themes on the left. I think you need to just position differently than years past. But when the black line goes up, which is commodities on this slide, that green line, deficits are going up with it. Every government globally is going to be running deficits for the upcoming years. But when that black line goes up here, it's the same as the black line going down here. And the following light blue line is broader market valuations. And so we would just tell you every commodity cycle puts pressure on other sectors. This time is not different, and we think that that will be the playbook in the coming years. I think to get everyone to understand, energy's more than just oil. I know it's topical to talk about oil today. To call it out, I wish our fund was just an oil fund to start the year. We've done really well. But you kind of just look at how the oil names have done, and they've done really well. But as you think about the Canoe Energy Funds, we are broad-based in our approach. We look at nuclear, we look at alternative energy, we look at global LNG and oil and liquids-rich natural gas and service companies and infrastructure and building out the grid and power. And I think this is really important for what's happened, specifically on the energy demand tied to AI. To put this into perspective, there's 50 gigawatts of power planned between now and 2030. 1 gigawatt powers roughly a 1 million person city. There's only 11 cities in the US over 1 million people. And so we're going to just pop up another 50 cities between now and 2030. Like, this is an inordinate amount of power. And I think this is just relevant for, I don't even think a lot of this is possible. I don't know where the power is going to come from. But I would just say, whether it's wars breaking out or it's energy demand tied to AI, like, we're changing the narrative on energy. 3-4 years ago, people are questioning if we even need this stuff. And now we're looking at energy demand tied to AI, global energy prices, and what's going on in the Middle East. Like, we're re-rating the terminal value of the sector. That's all we're doing. And it was valued too low. And now we're valuing it higher. And this narrative is really important, because when you think about global portfolio managers, they've made a lot of money in other sectors the last handful of years. And I would just say to you, it kind of feels wrong having 0% energy exposure in your portfolio today with what's going on. And that narrative shift is happening. And when you expand multiples over time on that narrative shift in that global manager coming in to buy energy, this can really re-rate sectors and stocks. So then it's important to understand, well, where are we today? And we were talking to the guys before we came on. It's like, well, where are we? Well, energy's 4% of the S&P 500. This is still a very low percentage in the grand scheme of things, okay? This is, in fact, one of the lowest weightings of energy of all time. So this is because other sectors have done so well. Like, to put this into perspective, the last energy bull cycle ended in 2014. And at that time, the S&P 500 was $17 trillion of market cap. Today, the S&P 500 is pushing $65 trillion of market cap. Energy back in 2014 was $2 trillion of market cap. Energy today is $2 trillion of market cap. 17 to 62, 2 to 2. Like, I don't think we're the risky sector, is my point. There's been a lot of other sectors that have done really well. And I showed you those commodity charts of when commodities go up, it puts pressure on other sectors. I think this is really important to think about where we are. We think those percentages are going to 9, 10, 11, 12. Over time, in the coming years, in the coming quarters, you'll get some drawdowns along the way that you should buy the dips. But I just think it's really important to understand this is a relative chart. We're not going to 9, 10, 11, 12% just with energy going up. It's other sectors going down and energy going up. It's the combination of those two. So that's kind of our playbook. We think that energy has been underinvested in. We think portfolios are underrepresented in energy, and they're figuring that out over time as we kind of think about the year-to-date start. But I think it's really important to understand where we are. And I'm not telling you it's going to go in a straight line and there's not checkbacks, but I think that this makes me feel like we're not the risky sector in the market as we think about where the bulk of the capital is. There's a lot of private investment that's coming into our backyard. This has been happening for a while now. And so I would just tell you the private guys are coming, and it's also changing on, like, the US guys that left Canada are coming back to Canada, the Ovintivs of the world. Yeah, but like the super majors are all bearish Canada. No, they're not. Total bought a stake in Sea Lisms last year in the middle of the election. Mid-Ocean, Saudi Arabia showed up here last year, bought 20% of Petronas' Northeast BC assets. Everyone just wanted to talk about pipelines and Carney, but Mid-Ocean's buying 20% of Petronas' Northeast BC assets. The pensions of the worlds are coming back to energy. You just had the Shells of the world come in to buy ARC Resources. So the capital's been coming back for a while now, but investors haven't wanted to pay attention to it. Every question I get in post-meeting is, yeah, but policy, yeah, but pipelines. And we've been trying to get our investors off of this, but they're waking up to it over time, right? When you see an ARC Resources transaction last week with Shell, quietly our Tourmaline position has done pretty well the last 10 days. And so the resource is going to re-rate over time. And with what's happening across the globe, we are really waking up that our resource is potentially not priced properly, and we could be doing a lot to supply the world with Canadian energy. So we have all been frustrated with what the policy has been, but the resource will always re-rate over time. And we think that we've been going through that process, and we think that that's going to continue. So, like, we can see the big picture setup. I've set this up for you guys, 4% energy weight in the S&P. I don't think we're the risky sector. But to talk a little bit more about the here and now and portfolio positioning, I think it is important to think about what's been going on and what sectors have been working and that type of stuff. So to start this all out, we are in a global energy shock, okay? I know the market's at an all-time high. I know we're sloughing this off, but when you go and backtest shocks, it ain't good, okay? 1990, that oil shock, things kind of went up on oil prices, then they went back down. We did kind of skate on side there. Every other oil shock, not good for markets. And so this has kind of been one of the bigger energy shocks we've seen in a long time. And I think the market's a little naive to these shocks. And so when I kind of go and backtest those comments, your portfolio manager at Canoe is not guns out, let's take oil to 150 and everything's going to be awesome in energy. We've been a little bit more in risk management mode. I don't want to blow our clients up. I want to manage risk. I want to make performance in energy while trying to manage some risk. And so, again, how I was talking earlier, to call it out, I wish we were just an oil fund to start the year. But we had 30-40% of our fund exposed to oil. Today, that exposure is less, given what's gone on. The stocks have done really well. Some of our oil names are up 75-80% on the year. Some of our oil names have tripled in the last year. So everyone's been very bearish oil the last bit, and now it's hard to find an oil bull in the room. I'm not calling the end for oil equities, but I think it's important to think about what could be the next place within energy. And that doesn't mean oil equities need to implode. It just means you might want to be in some other areas. And things we've been saying to our clients the last 30 days, I think this is going to be the opposite of COVID. So what was like COVID? When we all came out of COVID, the mindset was oil is going to be 40 to 50, really low for a long time. The big integrated Chevrons and Exxons and Suncors and CNQ, they V-bottomed. They did not go down that long. You had a couple days or a week to buy them, and they right away started going back up. As you think about areas that didn't do as well, areas that weren't getting capital spending on them, like royalty companies and services, those businesses did not do well. The royalty names like a Prairie Sky or a Topaz or the services, they went down. They stayed down for months, 8 months, 10 months. They didn't rally. And we think this is the opposite. Any way we slice and dice it, the commodity prices are going to level out at a higher price than we were at 2 months ago. We can't go back to $55 oil. We can't go back to global LNG prices at $7. They have to stay elevated in the teens, given Qatari outages and stuff like that. And so I think we just don't know what the right medium-term price is. Should we be at $70 oil, $80, $90 oil? Well, everyone today is thinking higher. Well, what if oil goes to 150? This could cause a global recession. This could send the globe into a global depression. The stocks will quit going up as the oil price is going up. They'll be going down with markets. So we don't know how this is going to play out, but owning nothing but oil after they've been the best area doesn't feel like the right call to us. We think what's going to happen here is there's going to be more global spending. This is the start of the spending cycle that we've referenced for years that we haven't had. And this will take multiple years to play out on that capital spending. But we think some of these services and royalties that were the worst stocks coming out of COVID could be the best. And the best part about it all is what's been the worst performing subsector the last 2 years? It's been services. It's been Halliburton, Schlumberger, Big Bellwether Service. What about the royalty names? Our Topaz and Prairie Sky positions. They were flat last year. Now they've done okay and they're up 15, 20% this year. But they're not up 90 in the last year or tripled, okay? So this is a good place that if we go into a global recession, which is not our base case, but it could happen, we're not going to blow our clients up. That doesn't mean we don't go down, but we are shifting some capital around here. And just to talk through some of this, like that 1973 oil embargo was the last oil shock. Oil prices quadrupled. S&P went down 50%. Oil names went down 35% because it got messy in the broader market. Government policy also got really sloppy, okay? Government started to price cap or put caps at the pumps on gasoline and diesel prices. This caused those big bellwether oil names to go down. You never made money on those big bellwether oil and refiners for the next 4 or 5 years coming out of that 73 shock. In the meantime, stuff like Schlumberger on the right tripled their market cap. The stock tripled while we went into a 50% drawdown on the S&P. These are relevant things to think about. And so within our portfolios, we think you should still be in some mid-cap names. We've put those across the funds. When you think about our Prairie Skies and stuff, like, we're not saying they're not up, but look how this land base has over tripled since the IPO, and the valuation at the IPO was 25, 30 times cash flow. Today it's 15 times cash flow. So other royalty businesses in the US trade at 30 to 40 times cash flow. These are good risk-adjusted areas for our clients, okay? And so these are places that we've been. You can see when you just go by, a lot of people have just run into oil here and Suncor and CNQ and Cenovus. I don't want to make it sound like those names need to implode. They can do okay. But we think if the call is that Suncor is going to go from $93 or $80, $90 up to $120, we think some of our other areas are going to do quite well too. And like I kind of referenced, the super majors coming back and bigger pools of capital, like the big thing for me is 3 years ago, it was David Shabunka in a room by himself having a party by himself. There was no friends at the party. Today, there's more friends showing up at the party. Just because there's more friends doesn't mean I have to get all bearish, okay? There's more global managers caring about energy. There's more private equity in Calgary. There's more U.S. producers coming back. The super majors are coming back. But we think the portfolio positioning needs to reflect that. And our gas names have been the worst performing subsector on the year. And then you have a Shell come in to buy ARC last week. Our ARC position crushes it. And our Tourmaline position is the best name for us in the last kind of 2 weeks in the funds. So this will all change over time. But I think we're on the right themes of more global spend, maybe shift some oil to or serve oil out of oil into service. Don't forget about the gas guys. With what's happening, global natural gas prices are $20 an MCF. Okay? In Canada, they're $1 to $3. You don't think the global guys are going to come in to close that arb, or countries that are paying $20 an MCF in Asia? They're going to close the arb, you guys. And some of the gas names really haven't moved yet when you pull up those charts. And so we think there's places to manage risk because we're in a shock, but not just look up, manage some risk, position some capital. But I would tell you the last 2 months have been very chasey selectively on oils. And we think you just need to manage some of those weightings in the funds. And that's kind of what we've done. You've seen us move around to have less oil, to have a little more service, tweak up our gas. Our royalty weights are roughly flat. Our big integrated oil weights, large caps, are way down. We own 0. And we have a touch of cash. And this all in a mixer feels pretty good. And I want to bring you back to, you guys, this is a very easy medium long-term call. Okay, we're 4% energy weight in the S&P 500. We're at the start or in the infancy of the optimism phase of the cycle. And we can see that this is all good, but we think markets are quite complacent for what's going on. That's more of a broader market comment. But risk happens fast, and we want to make sure that we're trying to manage risk as good we can. As an example, a couple weeks ago, we'll all remember, Trump comes out. We got a peace truce deal. Oil was down 17%. C&Q was down 9% on that move. Our Schlumberger was up 3% that day. We never nailed it perfect, but the Canoe Energy funds those days were down 1.4, 2%. Broader energy funds were down 6%, as oil was down 17%. So I think we're on the right track of kind of maneuvering around various subsector approaches, but don't forget where we are. You're in the position of the cycle where you want to ride some of this out, build positions if energy stocks come in, and we just don't think we're the risky area of the market, if you will. I'll leave you with, we have 4 funds at Canoe. I'm not sure which ones you guys own or are positioned in, but I don't think there's a bad fund. I think it just depends on, just understand yourself and where you want to be. When you go through periods like last April and Liberation Day, like the broader energy equities went down 20% in 3-4 days. So as much as you're like, we should add to these energy equities or the Canoe Energy Fund or whatever that is, it's hard sometimes. Everyone wants all the up, but they don't want the down. And I would just say the 2 funds on the left are long-only energy funds. They don't have any shorts to manage risk. But for where we are in the cycle of that 4%, you might just want to be long owning energy stocks. But don't forget about Liberation Day, and sometimes it's not easy to add in those drawdowns. Sometimes you're lying awake at night going like, I'm worried how well these stocks have done. So just be honest with yourself and ask yourself, if we do get a bit of a check back, are you adding? David is trying to manage this with his partners, Nick and Courtney, on the Canoe Energy team in the background. We're moving down and out of certain subsectors, so we're trying to manage the risk for you, but these are long-only funds, and they will go down with energy if energy is going down. The 4% yield on the income fund helps people ride that out. You're getting a 4% annual yield that gets paid monthly. So what I would tell you is, we do have 2 funds on the right that are long-short products. We can manage a little more risk in that. What does that mean? We can buy equities and be long, but we can have some shorts on there. Sometimes we can short futures on oil to short the price of the commodity. We can put on energy index shorts. We can put on broader market shorts. We sometimes have a big option book where we have calls or we have puts. Sometimes we're gas pedals. Sometimes we're brake. And we've done a good job of managing this in the Canoe Energy Alpha Fund for the last decade. The returns have been quite staggering in a pretty choppy energy market. We've done really well on this fund. The problem with it is it's money in monthly, money out quarterly, not TFSA eligible, not RSP eligible. And so last August, we created the Canoe Energy Plus Fund to try and mimic that Energy Alpha Fund, daily liquidity, TFSA eligibility, RSP eligibility. And so these funds are a little more risk adjusted. On the year, our Canoe Energy and Energy Income funds are up 30 yen. These ones are more up teens. I wish we had no shorts. I wish we had no puts. But for how well maybe you own some stocks that have done really well and you just want to take some risk down, these 2 products on the right are a good avenue to do that. Or you might just want to say, you know what? I just want to ride this out. I believe you in the cycle. And if things come in, I will add more. And you own the funds on the left. So I would just say to you, clients always want all the up and no down. It doesn't work like that in investing. Understand yourself, put yourself in the right fund, and I don't think we have a bad fund for where we are in the cycle today. So maybe I'll just pause there. We can open it up for questions. I know, Bob, you said that we had to show a disclaimer slide that I want to make sure that I hit up. But yeah, we can open up to questions if there are any.
Yeah, so folks, if you do have a question, just click on the Q&A tab or the chat and type in your question. Happy to have Dave answer them. While we're waiting, I'm going to ask one on natural gas, Dave. So you had mentioned that the global natural gas price is around $20, and Canada 1 to 3. So how are Canadian companies going to take advantage of that difference, and does that put a company like Tourmaline in the crosshairs for a takeover?
Yeah, so when you think about gas and how we approach our subsectors, like when we buy the gas subsector, there's good companies in Canada, there's good companies in the US. And so you owning the Canoe Energy Funds don't just own Canadian natural gas. You own, in fact, 2/3 of your natural gas weight, of our weight in that fund right now, is US gas. And so this is it. When we debate this, I would just say it doesn't matter if we're in the US getting $2.85 or you're in Alberta frustrated that we don't have more pipelines at $1.40. It's been the second warmest winter on record. 12 months ago, everyone loved gas. No one liked oil. Everyone liked gas. Why did they like gas? Because of this slide right here on the power. Energy demand tied to AI. But now everyone's a weather expert, and now everyone's bearish because the gas price is $2, and we've just been saying, I don't know, like, we think that the resource is really mispriced. We think that the resource is priced in the hole because there are countries globally paying $20 an MCF or physically can't get the gas right now. Like, there are countries that are shutting down because they can't get products out of the Strait of Hormuz. So if you fast forward the clock, and I just think we're going to see more global capital come to close that global arb. And I kind of cited 2-3 weeks ago, Shell and these big boys, like, they haven't invested the last 2, 3, 4, 5 years. They've all been chasing ESG, underinvesting, shareholder returns, dividend buybacks. But now, like, they've been writing their reserves down because they haven't been investing that much. So we've been thinking, like, I know everyone's getting all fired up on oil because of what's going on in the Middle East. I'm telling you, the molecule of the future for hydrocarbons is natural gas. This is the next 20, 30-year molecule. And we're really discounting it today in Canada, in the US, for how required it's going to be. So we're not that surprised when we see the Shell pick off an ARC. And the Tourmaline could be next, but even go think about the Exxons, the Chevrons adding to gas in the US. Or the big Mitsubishi Petronas is coming to buy more gas and putting it on a ship with Cheniere to send it back to countries that physically can't get the resource. These ARBs are going to be closed. And I hope as a Canadian energy investor that we get surprised a little bit on more LNG exports off the West Coast. Today we're 2 BCF a day. We see avenues that we're going to go to 4, 5, 6 in the coming few years here. 2028, 2029, 2030. The world is calling for our gas, you guys. They don't want to do a deal with the US. They want to do it with us. If we come out of this and we're supplying 11, 12, 13, 14 BCF a day off our West Coast, we can make a lot of money off that. Profits, royalties, jobs, all of this. So I hope that's the outcome. But don't get emotional as a Canoe Energy portfolio manager. We will put the chips where we're going to make money for our clients. And we will play the Tourmalines of the world, but we will also play the US gas guys. To call it out, if I was a big boy coming in today, that's where all the egress and LNG exports are. The US 3 years ago was 6 BCF a day exports, then 10, now 20, going to 30 in the next 2 years. We're sending our gas down to them. That's what I would buy if I was a US guy. More of that. Put it on a ship with Cheniere and send it somewhere else across the globe. We have better resource, right? So I think balancing all these things in a mixer, just like, I think there's opportunities in both areas is what I'm saying. I hope one of them really plays out positive for Canada, but we will play it where we think. But we think the gas guys today are very unloved, and everyone's chasing oil, and we're kind of going the other way a little bit on that. And we're playing services and royalties and stuff like that too.
Okay, Dave, kind of a two-part question on that theme of natural gas. I believe a year ago today, you and I were in complete agreement how we had a lost decade with our previous government here and giving up the biggest opportunity probably in the history of this country by not pursuing those LNG sales. So my question would be two parts. Number one is, what would be the main determinant of natural gas in the U.S.? More for domestic demand from AI centers and maybe a cold winter, or is it going to be from the marginal increase from this LNG, obviously increased exports?
The answer is the latter. And so the LNG is the big pitch. So when you have global LNG from coming out of the U.S. go from 6 BCF a day of exports to 10 to 16 to 20 to 26, that's a big driver. And that's gas going to other countries across the globe, displacing coal. Like, the biggest theme that I see that's going to come out of this war is governments globally are really going to push electrification. That's what China did, you guys, okay? China's so smart with how they handled this for the last 5-10 years. They saw that there was 1.5 billion people in China using 3 barrels per person per year within China. Well, so when you use 3 barrels per person per year in China of oil, like, that's 14 million barrels a day of imports that you have to have. That's a lot of oil on ships coming to China. And they said, we're such, like, to put this into perspective, in North America, we use 20 barrels per person per year. Okay? Like, that's a lot of difference. And they're going, I don't want this 3 barrels per person per year to go to 6. Then I'd have to import 28 million barrels a day like, as a country. Very beholden to Russia, to Iran, to the Middle East. So they pushed the electrification agenda. The electrification agenda was, let's have more EVs, more transmission, let's build out the grid, and we will get the electricity with coal, wind, solar, uranium, LNG. Let's diversify. Let's build up strategic reserves and all that stuff. More of that. They were smart. They are smart. And I could see more countries following this lead as you play this playbook out. They're going to want less exposure to oil coming out of the Middle East with what's going on. And so I think this just has implications too. There's going to be a big call on natural gas here for a while. And global LNG exports, like all that gas that was coming from Russia to Europe, Trump used this in the negotiations with Europe on the Trump tariff negotiations. You know what? We will set your tariff down here, but you will buy U.S. natural gas. And you will get that U.S. natural gas in LNG form, and we will be your provider and your friend. He who controls the resource and where it flows has all the power. So the global flows are shifting, but I would just say to you that the big driver of this whole gas push is global LNG. But the thing that's interesting, Daryl, is I never had this energy demand tied to AI in my backyard. I did not have that on the cards 3 years ago. It just kind of came up. So what are we doing as a North American kind of country? Increasing exports, using more domestically, less coal, more natural gas, more power, more exports, and we keep filling to the same brim every year for winter. This is going to end bad. Like, this is going to be more volatility, price spikes in winter. Wake me up when we get a cold winter. And it used to have to be, it just was in North America. When now with what we're doing with all the exports, it could be Europe, it could be Asia, it could be North America. We're beholden to more volatility, more price spikes. And I think this is really important for how the world is shifting, but it kind of screams a little bit of an opportunity and so where some of this natural gas resource is valued in our view in our portfolios.
Okay, so part two of the question, and this would be from one of our more kind of timid participants, I'll say tonight, that didn't ask the question. Could you tell us the day the natural gas price is going to start to go up?
I would tie your brain a little bit off of what's the natural gas price and more onto where the natural gas resource could get re-rated. Like, the pools of capital are coming back, you guys. And the pools of capital that are coming back are abundant, right? It started with private equity. Now it's the US guys coming to Canada. It's the Middle East guys coming up. It's the pension capital that was out on hydrocarbons that's now back. The resource could really get re-rated here. And so the price will take care of itself over time. Okay, low prices cure to have higher prices. And it's the same thing the opposite direction. Look what's happening on oil. We're going to spur more investment here globally because of everything going on. That doesn't have to be a bad thing. It's just, I think you got to not focus so much on the price of the commodity and more on the resource. Specific to the price of the commodity, we just had the second warmest winter on record. It's been really warm. And that is why prices are where they are. But when you see global gas prices priced where they are in the $15, $20 range, and it's cheap here, these groups on this screen are going to close that arb. And that's how we're all going to make money in the stocks.
Fair enough. I said two parts, but one slight part three. Do you think the previous prime minister should be criminally charged for not allowing those exports to Japan, Germany, and Greece? And thank you very much, David.
I just think it's very unfortunate because the world would be calling on our resource right now, and we'd be going to them saying, "Yeah, we're not ready till 2028, but just hold with us." And so it is what it is on that. We all know what we could have, should have been doing. I just think that this is such an opportunity for us to say, can't help you in the next 2-3 years, but beginning 2030, let's provide gas to insert the country. Like, if we don't see these deals signed in the next 12 months, I don't know what we're doing as a country. Because the world, I'm telling you, they will pick us over the US. And they want our resource. And even for these countries, like, there's a lot of Asian countries that get a lot of gas out of Qatar. And they're using more gas. With what is happening here, and they already have, let's say, 2 big deals signed with Qatar in the Middle East, Strait of Hormuz. You're telling me that New Zealand wants the 3rd deal through Qatar too? They're going to start diversifying with what's going on. So we just need to be there to kind of hold the flag to say, we will help. Let us help you. And I think that this is going to happen, but it's a heck of an opportunity for us, and I hope we close that.
Absolutely. Thank you. Matt?
Still no questions, folks. So please don't be shy and enter a question in the Q&A or the chat. I'll ask
Q&A is working, Matt?
I believe so. It should
Okay,
be.
I'll just double check.
Yeah.
We've had that problem before.
Well, I'll ask a question, Dave. Kind of a review of the webinar you did for us a year ago. So I think our thesis last year was that these energy companies, even if the war ended today and oil went back to $70, these companies have spent a lot of time cleaning up their balance sheet, right? And are in really good positions to be making money going forward. Is that still the case?
Yeah, so I would say a couple things on that. I would say the stocks, some areas of energy have done really well the last 12 months. So the industry is building cash here, and the old rule in energy is follow the cash and good things happen. They're getting a big windfall with what's going on, the whole industry. It's going to result in a little more spending, more dividends, all these various things which are good for shareholders. And so that is happening. In certain areas, you're paying more for that today than you were. Some energy stocks have tripled in the last 12 months. So yes, if oil goes back to 70, they're still building cash and all this stuff. But I think there could be more downside in some of these names. And that doesn't mean they go get cut in half, but maybe they retrace 25% or something like that. So I think I've gone from being like last year, I was a little bit more of pounding the table on the whole sector. And now I would say it's a little more specific for us. We still see a lot of really good ideas. Energy is only 4% of the S&P. And I think the flow of funds can really dominate. When I give those numbers on the broader market, 17 trillion has gone to 65 trillion. 2 trillion energy from that 2014 period to today, we could have a lot of money come our way, which could take a lot of valuations higher. But I would say it's a little more specific for us on where we're putting the capital. It's not a blanket comment, right? Because there have been some energy names that have done really well.
Great. Thank you. We got one question here. I'm actually going to see if we can get it.
You get it,
Yeah.
Matt? I think it was on electrical.
Yeah, I saw it and then I lost it. I
Yeah,
think
that-
it was what electrical companies do you have in your fund, I think is
Yeah,
what
I
it
think
was.
that shy participant just asked the question.
Yeah.
Go ahead.
Yeah, so I would just say a couple things on that. When we think about like multi-year themes and trends that are relevant, and then you just got to debate like what's your point of entry, because some of these stocks have done well too. It's like building out the grid, more transmission, more power. Like these themes are a super cycle theme where you ride some of these things. But there's been some big moves in some of these areas, right? And so some of these transmission companies that are building out the grid have had really big moves in the stocks, and you're paying a lot more for that today than you were. So we like uranium. Like we've said, we like uranium, but we're not sure on our point of entry. Some of the uranium equities have done really well. So we don't own any today, right? And so to specific to the question of where are you positioned on the power, if you will, we have some TransAlta, we have some Capital Power. Those stocks have actually come in here pretty good. And we've added to some of those areas that are actually the producers of power. And so that's been a small component within that. And I would say we own a decent chunk of our fund in natural gas, which is going to be the source to supplying a bunch of this power. So there's second derivatives everywhere in the services that you'll need for natural gas and all that stuff. But specific to electrical companies, that's kind of the answer in the power companies.
Great. So you've mentioned a couple times. So just mentioning uranium, I thought about NextGen and how they're going through the permitting process now. And you mentioned Carney a couple of times. So it's been about a year since he's come into power. Are you seeing a better regulatory environment in Canada? And you've mentioned, the more capital's coming in. Is that a result of a more positive regulatory environment?
Yeah, I would say like when post-election, I forget exactly when we did this webinar last year. I know it was around this time, but like the day after the election, like our CEOs on the top of all these buildings downtown on suicide watches. They're like, oh my God, I can't believe we have another 4 years of this. And I would just say, we were saying to our investors, everyone is just expecting the absolute worst on all of this. Like nobody thinks anything positive can happen. So just don't necessarily look nowhere but down. Let's keep ourselves open to positive surprises. And what I would say to you is, in January of this year, when you're talking to all the oil companies across Canada, like they have not been this positive, oil pipelines and getting their product out of Canada in a decade. They're all going to us going like, I have not seen this many projects going on behind the scenes in 10 years in Canada. Think TMX expansion, think that old Keystone XL pipeline that the Trump administration just said go last week, right? So these things have been getting worked on and we've been bang on with that. The LNG side, I mean, Shell just came in and bought ARC. Shell's a 40% owner in LNG Canada. They just kind of told you phase 2 is a go. Clearly, there's been conversations with Shell and our prime minister. You saw Total come in last year and buy a stake in that Sea Lisms LNG project. This is another big LNG project on the West Coast. So you're seeing the capital kind of go, but to your point, like, I feel like the producers are positive, but I feel like I kind of want more. And like, where are we? Let's go. Come on. But we are seeing the right signs. Like TransCanada came out here a month or two ago. They're like, we're expanding this pipeline to the West Coast. Again, like TransCanada expanding pipe to the West Coast. You don't do that unless more LNG's coming. You don't come in if you're Shell to buy ARC unless you're doing phase 2. So I think we're seeing the right signposts. And that's how it generally works. You don't see You don't get all the news and then are able to buy the stocks at yesterday's prices. You kind of got to buy the stocks and make a call. And right now, I'd say we're getting the data points. We always want it all. And to your point, policy never determines the cycle, but policy can pour gasoline on the fire. And when you see encouraging U.S. government policy that's been better than you the last 2, 3, 4, 5 years, the whole energy cycle is turning. And like when we bought natural gas as a subsector in 2024, we bought U.S. gas stocks, not Canada. Thank God, because they went up 70% as our Canadian ones went up 10 to 20. So policy does matter, but you shouldn't focus on policy for the cycle and get bullish or bearish based on policy alone.
Great. Good. Well,
Matt-
I don't
Matt, I
have
think we
any
have
other
another question in
on
the chat.
There's another question in the chat?
I've got a hand raised here. No?
I don't see any other questions. John, I made your mic enable if you want to ask a question.
Yeah, I show his hand up, but you don't.
Yeah. I see the hand up, so
Okay.
his mic is enabled if he wants to take himself off mute to ask a question. All right.
Okay, good.
Good. All right. Anything you want to add, Daryl?
No, as always, very informative, David. We really appreciate Bob and his team there allowing you to spend an hour with us tonight. Obviously, a year ago, I followed many of your suggestions and very, very grateful for them. I agree with you. I think natural gas is a very cheap commodity. Is an old bean trader. You're right. Low prices cure low prices, and I can't wait to invest.
Okay, thanks for the time, guys, and thanks everyone on the line for taking the time too.
Absolutely.
We really appreciate it.
You
Well,
do
we
too,
really
yes?
appreciate everything you guys do for us. Bob, did you have anything else you wanted to add?
No, I just think it was great to be able to circle back almost 1 year to the day, and I think the takeaway is without getting too close to the euphoria, it sounds like positive things are starting to happen and fall into place, and we're thankful for the opportunity to manage the assets and help you and your clients take advantage of the opportunities that Dave and the team see on a go forward. So thank you again for the invite, Daryl and Matt, to have Canoe on the line again. We'll look forward to doing another one.
Absolutely.
You're more than
Well, we
welcome.
appreciate it.
And Matt, I guess we'll suggest as this is the last of our webinar series, very grateful for the people who have tuned in. We got some pretty regular attendees. And once again, if you have ideas or suggestions for future webinars, we're glad to entertain them. This one will be posted on our website, so feel free to share it with anyone. Matt, you can add?
Yeah, it'll be on our website, our Facebook page, and our YouTube channel. So feel free to share it with anyone that you think will enjoy it.
How about we have Dave back a year from tonight?
Absolutely.
Right
I'm
on.
good for it.
We'll put it in the calendar.
Absolutely. Thanks to all. Everyone have a good summer, and look forward to back in the fall. Obviously, call Matt and I and Donna anytime at the office to get further information. Will there be also slides available, Bob?
We can make the deck available for sure.
Yeah, we get quite a few requests on that actually. So if
Okay.
Dave is good with that, we would like access to that in addition to posting on our website. So thank you.
Okay.
Okay.
Great.
Okay.
Thanks,
Thanks,
everybody.
everyone.
Appreciate your time.
Thanks to all. Good night, folks.